I think the same rules applied 50 years ago, applied 5 years ago, apply 20 years from now. First of all, you have to know what you own, whether it's a fund or a stock, and you have to have a reason for it. And you ought to be able to explain to an 11-year-old in 2 minutes or less why you own this. And this sucker's going up is not a good reason. I've tried that one. Doesn't work.
That's legendary investor Peter Lynch and the author of One Up on Wall Street, one of the most practical investing books ever written. In that book, Lynch laid out 10 timeless rules that help him crush the market, and they still work today. Hey, I'm Brian Feraldi. I've been studying super investors like Peter Lynch for more than 20 years, and in this video, I'm going to break down his 10 most important rules from his book, One Up on Wall Street. Now, rule number 1 is the most important, and that is to know what you own. Lynch made it super clear that every investor has to know what they own and why they own it. Now, that rule means understanding the core fundamentals of a company, such as what it does, how it makes money, who its customers are, and what could go wrong. Now, as an investor, you don't need to know every financial ratio by heart, but you should absolutely know the story behind the stock in plain English. Rule number 2 is to do the research. As Lynch said, the person that turns over the most rock wins the game. Lynch believed that the real edge for individual investors comes from digging deeper than most people are willing to. That means looking beyond a company's headlines and learning about how the company actually operates. You need to understand its products, its numbers, and its long-term growth potential. That brings us to rule number 3, which is to stick to what you know. Lynch said that the worst thing an investor can do is to invest in companies they know nothing about. Lynch warned that buying companies you don't understand is one of the fastest ways to lose money. If a business is so complex that you can't explain how it makes money in plain English, it's probably best to skip that idea and move on to something else. The safest place to start investing is with the industries, products, or services you already use and understand as a consumer. Now, as an aside, I made one-page visual summaries of the 10 most popular investing books of all time, including One Up on Wall Street, and I compiled them into an ebook. If you want a free copy of that ebook, just visit longtermmindset.co/10 books or click the link in the video description and let me know where to send a copy. Now that brings us to rule number 4, which is to buy simple businesses. I love Lynch's quote here, which is to go for a business any idiot can run, because sooner or later, one will. Lynch loved to invest in businesses that were easy to run and easy to understand. Lynch believed that if a company can thrive even with average management at the helm, that's a sign of a really strong business. Lynch also pointed out that simple, durable businesses tend to survive leadership changes and market turbulence better than complex ones. Now, rule number 5 is to look for everyday gems. Lynch said that if you like the store, the chances are that you'll like the stock too. In fact, Lynch often found his best stock ideas by paying attention to what him and his family were actually purchasing as consumers. Lynch earned 10-bagger returns from businesses like Dunkin' Donuts, Hanes Brands, and La Quinta Inn simply because he noticed that his family had good experiences as consumers of these companies' products. So if you notice that a store always seems to be busy, or there's a product that all your friends and family are talking about, that could be an early sign of a winning company. Your everyday experiences as a consumer can give you an edge long before Wall Street catches on. Now, rule number 6 is to hold through volatility. Lynch said that people who succeed in the stock market also accept periodic losses, setbacks, and unexpected occurrences. Lynch knew that even the best companies have bad days, bad quarters, and sometimes bad years. Successful investors accept these short-term drops as part of the journey to long-term gains. So if you believe in the company's long-term story, you need to accept that volatility is just noise on the way to long-term compounding. Now, rule number 7 is to ignore market noise. Lynch said if you've spent more than 13 minutes a year analyzing economic and market forecasts, you've wasted 10 minutes. Lynch didn't waste his time trying to predict recessions, interest rates, or market swings. Most of these headlines are designed to get attention, not to help you make better decisions as an investor. Your real focus should always be on the business itself, not on the daily chatter around it. Now, rule number 8 is to let your winners run. My favorite quote here is that selling your winners and holding your losers is like cutting your flowers and watering your weeds. Many investors make the mistake of selling their best stocks too early just to lock in their gains. Lynch believed that you should let great companies keep compounding for as long as their story stays strong. He knew firsthand that selling a winner too early can cost you far more than holding a loser through a short-term swing. That brings us to Lynch's rule number 9, which is simply to stay the course. One of my favorite quotes of all time is that everyone has the brain power to make money in stocks, but not everyone has the stomach. Lynch said that the real challenge to investing is having the discipline to stick with your stock when prices aren't going your way. Markets are guaranteed to test your patience with fear, doubt, and noise. And long-term success comes from consistency, not from chasing every new idea. And that brings us to rule number 10, which is to control your emotions. Lynch famously said that far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in the corrections themselves. Lynch warned that fear and greed will destroy more portfolios than bad analysis ever will. Trying to time the market around corrections usually leads to missing the best days. And successful investing is about sticking to your process, not reacting to every bump in the road. Now, as a reminder, I made one-page visual summaries of all of these lessons, plus 10 other popular investing books, and I compiled them into a free ebook. If you want a free copy of that ebook, just visit longtermmindset.co/10 books, or click the link in the video description, and I'll email it to you for free. So those are Peter Lynch's 10 investing rules, and if you follow them, you'll avoid most of the big mistakes that everyday investors make. Now, Peter also pointed out that knowing when to sell is just as important as knowing when to buy. If that topic interests you, I've got another video where I walk through all of Peter Lynch's exact selling rules with examples. To watch that video, click the link that you see on your screen and learn all of the signals that determine if it's time to move on from a stock.